Look, the resource is, I think, to a large extent regarded almost as academic in the industry, unless you can convert it at some point or another into reserve. We had space for another 200 million tons of material on our tailings dam. Now that we managed to get the license to extend the size of the tailings dam, our 11.8 million ounce resource takes on a different complexion, because now all of a sudden we have somewhere to go with the tailings. So we'll be looking a lot at our resource optionality over the next few years to see the extent to which we can extend our life of mine. We had a finite life of mine determined not by the resource but by deposition space, and with that now having been addressed, we can really start looking at various optionality models. So we have access to roughly 800 million tons of material. I think realistically we could probably, over the however long that life of mine is, target and treat about 600 million tons. And considering that we're at the moment targeting around about 24 million to 25 million tons per year, I don't know how many times that it goes into 600 million or 700 million tons several times. So there are a number of careers that can, or career lifespans required in order to access that entire thing. I think the point is, though, that our resource has finally become less of an abstract notion and more of something that we can actually investigate with a view to resource optionality. Sure, the total capex, looking at total cost over a specific period of time, like financial year or a 12-month period, is about 5% of total cost, maybe a little bit less. That includes both the sustaining capex and also project capex. So we're a low capex producer, simply because our capex cycle is similar to that of a factory. You spend your reclamation infrastructure, you spend that capital up front, your pipelines and so forth. The plant's already been established, and once that's done, that lasts you the life of the resource. You don't have an ongoing opening up and development cost. So I think the peculiarity in our cost makeup is that we have relatively high cash costs because we mine high volume, low grade material. So the cash margin is less than what you would find in many other mining companies. But you add the all-in sustaining capex expenditure on top of that, and the all-in margin then starts looking far more favorable. So off that number that you quoted for December, over any given period of time since we came to the end of our initial capital infrastructure investment cycle, it's roughly 5% of total cost. That's correct, yes. So the approach that we take is that we want to maintain a cash buffer, roughly 1 month's working capital and working costs. And then we also want to make sure that we have enough money for near-term capex projects with due regard to our cash flow forecast or cash flow expectations. And the balance we then distribute. So we kept back a little bit more than, strictly speaking, we need in terms of this approach. But the idea is really to not sit on surplus cash. Our currency, more than half of our shareholders are offshore, so it's a dollar-based investment for them. And with a diminishing currency or a weakening currency, if you sit on cash for too long, you might be penalized. They might look elsewhere to invest their funds. So we, as a general rule, and in view of the fact that we don't have any very significant capital projects ongoing, as we informed the market earlier, the free cash that we have with regard to this buffer and obviously the near-term expenditure, that should go to shareholders. And I think that's the approach that we'll continue to follow. And hopefully we can take advantage of the favorable gold price conditions that are current in South Africa and continue to offer an acceptable return to our investors. Yes, look, we have a very large plant that consumes up to 10 MVA at any given point in time. So we would want to look at technologies that we could put in place over and above the number of diesel generators that we've got scattered at very sensitive areas. We've got 7 MVA of diesel generating capacity. That obviously is not a viable alternative, so we are looking at other means of supplementing electricity supply, and in certain instances even substituting. So one of the projects that we've been looking at and adding the numbers is solar power. The costs of batteries, though, I think makes that a less attractive option. So it's not power that you can store. Solar power is something that we'd be able to use while the sun is out. Another interesting option, which I think is technology that's rapidly improving, is conversion of coal into gas. So it's coal. It's not coal fired, but it's coal sourced, and that is also technology that we're looking at. And it's early stages, but I think that's probably in the longer term a more viable and more realistic alternative to power. At the moment, there's plenty of electricity going around. Eskom is, on the face of it, appearing to be able to delivering to the requirements of their remaining clients. And we're taking advantage of that. The grid is under pressure, though, and you do find, though, that the distribution network's under pressure. So the issues that we have with electricity supply at this stage mostly relate to interruptions of supply as a consequence of cables that are down or pylons that have been compromised, or something to that effect. For us, it's a matter of not just the cost, but also the consistency, and as a consequence, in order to further de-risk the business, we are looking into these technologies. And of course, with the ever-escalating price of electricity in South Africa, and likely to increase more with the number of paying clients probably on the decrease, with costs increasing, I think the cost of implementing these alternative sources are becoming more and more attractive. Yeah, the economies of scale in this business are sensitive. Key drivers in the business are, the 3 key drivers are gold content, volume, and metallurgical efficiency. A lot of the capex that we spent over the years have been, or most of it, have been infrastructure aimed towards enhancing metallurgical efficiency. We spoke about the flotation and fine grind circuit and several other improvements and enhancements. We seem to be hitting the numbers on metallurgical extraction efficiency quite regularly now. So there's a pattern developing suggesting that the metallurgical capacity of this plant is consistent with that which we had set out to achieve when we started these projects. Now, as a consequence, because we have a fairly good idea as to how much gold we'll be getting out once we introduce our throughput into the plant, in order for us to achieve our targeted production, it's now really become a matter of making sure that we achieve volume throughput. So volume throughput we consider to be the number one risk, or number one driver, so to speak, in order to consistently achieve production expectation or production target. And the issues that impact there, obviously, are availability of plant and infrastructure, so breakdowns, pipelines that burst, pumps that need servicing, and so forth. So you've got to have a very tight maintenance program, preventative maintenance program, engineering program. In addition to that, adequate supply of electricity, adequate supply of water. You've got to make sure that you don't break the rules. We're right here in the middle of Johannesburg, so you can't be polluting areas and having the regulator stop you from producing. So you've got to stick to the rules and keep those tight. So our de-risking initiative going forward, or our risk avoidance strategies going forward, to a large extent are focused on making sure that we get the volume throughput, consistent volume throughput.